Maduro, El Mencho, and now Khamenei. Just 3 months into 2026, and the US has gotten into more wars than ever before. Wall Street is already panicking. The headlines are screaming about impending market crashes, and oil prices are threatening to go parabolic. But while retail investors are panic selling, institutional money is making highly strategic, calculated moves. To understand exactly what the smart money is doing right now, I applied rigorous quantitative methods to pore over decades of stock market history tracking exactly how institutional capital flows the second a major geopolitical conflict breaks out. So I spent dozens of hours compiling all of this data into this video because the reality of how war actually impacts your wealth is very different from what the news is telling you. If you want to know exactly how to protect your portfolio and capitalize on the chaos, keep watching until the very end. I am going to break down the hard historical data, showing you exactly what crashed and what skyrocketed during each past major wars in the last 50 years. And then I will reveal 3 specific stocks that are mathematically and fundamentally positioned to surge as the war in Iran continue to unfold. Let's cut to the chase. So every time the US enters a major conflict, the market follows a surprisingly consistent psychological and economic pattern. Phase 1 is always the risk premium shock. In the immediate days following the outbreak of war, uncertainty rules and specific sectors get absolutely crushed. Look at the Gulf War in 1990. When Iraq invaded Kuwait, the market was terrified of a global oil shock. The S&P 500 plunged 16.9% over the course of 71 days. During this window, airline stocks and consumer discretionary companies plummeted as jet fuel costs skyrocketed and consumers stopped spending. Crude prices literally doubled in a matter of weeks. However, once Operation Desert Storm officially began in January 1991, the uncertainty vanished. In the 3 months following the start of combat, the S&P 500 surged 18.2%. We saw a similarly violent reaction after the 9/11 attacks in 2001. U.S. equity markets were closed for 4 days. When they reopened on September 17th, the S&P 500 plunged 4.9% in a single day, and the market suffered an 11.6% maximum drawdown over the first week, wiping out $1.4 trillion in value. Most of the commercial aviation was grounded, and the travel industry was practically wiped out overnight. Insurance stocks initially tanked due to fears of catastrophic payouts, though they eventually recovered once the liability was spread across the industry. However, the Federal Reserve aggressively injected liquidity. By mid-October, just 1 month later, the stock market had returned to pre-attack levels. And as the U.S. entered the global war on terror, defense budgets exploded. Companies manufacturing precision munitions, surveillance tech, and military hardware saw a decade-long bull run. The 2003 invasion of Iraq is the ultimate historical proof that the stock market hates uncertainty more than it hates actual combat. For months leading up to the invasion, the market bled out. The S&P 500 dropped roughly 14% due to the sheer uncertainty of the military buildup and UN debates. Oil prices steadily climbed from $25 a barrel to over $35, enriching exploration and production companies. Consumer staples and utilities went down significantly because the broader market rallied so violently once the invasion began. Capital rotated aggressively into risk-on growth and industrial stocks, leaving traditional defensive sectors lagging. However, on the literal day U.S. troops crossed the border in March 2003, the S&P 500 rallied 2.3%. It surged 13.6% over the next 3 months and finished the year up over 26%. Even more recently, when Russia invaded Ukraine in February 2022, the S&P 500 dropped nearly 7% in the immediate aftermath as the world braced for energy and commodity shortages. However, the market fully recovered those initial invasion-related losses in just 23 days. Notice something? This is where the data gets incredibly important and why tracking institutional moves is so critical. If you sell during the shock, you completely miss phase 2, the rebound and rally. Markets historically absorb the shock, reprice the risk, and march higher as government wartime spending acts as a massive economic stimulus. Who were the biggest winners? Defense contractors. As the U.S. showcased its modern military capabilities, companies like General Dynamics and Northrop Grumman surged. Lockheed Martin reported an 18% increase in revenues and a massive 23% jump in operating profits in the first quarter of 2003 alone. We saw this exact same sector rotation during the Russia-Ukraine invasion in 2022. While the broader market struggled, commodities and energy shot up violently. Brent crude spiked from $90 to $120 a barrel in just 14 days. As a result, the S&P 500 energy sector was the absolute standout winner of the year, surging a staggering 27.1% over the 12 months following the invasion. The golden rule of wartime investing that the data proves time and time again is this: the market hates uncertainty more than it hates war. Once the bullets fly, the uncertainty is removed, and Wall Street violently shifts capital from consumer and travel stocks right into the industrial and energy base. For this war in Iran, to understand the immediate market reaction, you have to understand the geography. The central nerve of this conflict with Iran isn't just about geopolitics, it's about the Strait of Hormuz. Roughly 20% of the world's global oil supply passes through this narrow maritime choke point. With shipping companies freezing transit and insurance premiums skyrocketing, West Texas Intermediate and Brent crude oil futures instantly spiked. If disruptions continue, we are looking at oil easily pushing past $80, $90, or even $100 a barrel, which acts as a massive tax on the entire global economy. So based on the disruption of the Strait of Hormuz, the realities of U.S. military mobilization, and the historical data I just walked you through, here are the 3 specific stocks positioned to break out. Number 1. Lockheed Martin. Lockheed is the undisputed heavyweight champion of the U.S. military apparatus. I previously made a video about which defense stocks will go up the most during this administration. You can click on the top right card to watch. So Lockheed Martin aren't just selling bullets, they are selling the ecosystem of modern warfare. While they are famous for manufacturing the F-35 fighter jet, their real value in this specific conflict comes from their precision munitions. In modern, asymmetric conflicts, precision weapons are burned through at an astonishing rate. Lockheed produces the Guided Multiple Launch Rocket System, GMLRS, and the PAC-3 missile defense interceptors. When the U.S. military drains its stockpiles, they are forced to sign multi-billion-dollar replenishment contracts with Lockheed. You are looking at a company with an impenetrable economic moat. BlackRock quietly added 85,176 shares, a 5.1% increase to their total position, approximately a whopping $412 million disclosed in their latest filings. Number 2, RTX Corporation. Formerly Raytheon, RTX is the absolute global king of air defense. When you see news footage of incoming drones and ballistic missiles being shot out of the sky over the Middle East or the Red Sea, you are almost always watching RTX products at work. They manufacture the Patriot missile battery and the Standard Missile family, SM-3 and SM-6, used by U.S. Navy destroyers. Iran's primary offensive strategy relies heavily on overwhelming drone swarms and ballistic missile barrages. Defeating that specific asymmetric threat is exactly what RTX was built to do. During times of macro volatility and geopolitical crisis, institutional capital heavily rotates into RTX because its earnings are essentially recession-proof and war-guaranteed. Note here, Vanguard Group bought approximately $405 million and added 22,10950 in shares, marking a 1.8% increase. Number 3. ExxonMobil. If the Strait of Hormuz sees continued military harassment, global oil supplies will tighten instantly. ExxonMobil is the ultimate energy hedge for this exact scenario. Thanks to aggressive capital expenditures, Exxon controls a gigantic swath of the U.S. Permian Basin. Furthermore, they operate highly lucrative, world-class offshore drilling projects in Guyana. This means they produce a massive amount of crude oil strictly outside the Middle East. This geographic insulation is the key to the thesis. Exxon is perfectly protected from the physical danger and shipping lane closures of the Iranian conflict, but they benefit completely from the surging global price per barrel. War brings immense tragedy and volatility, but letting panic dictate your portfolio will only wipe you out. Look at the data, understand the macro shifts, and position yourself alongside the institutional money. That's it for this one. Please drop a like and subscribe if you enjoyed the content. I would really appreciate it. Until the next one.